Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, August 17th, 2021. It is 10:22 Eastern Time as I'm starting the video, and what we're going to do is look at several sectors. We'll start out with a brief overview of the broad markets. Again, not a whole lot new to update other than the low volume indicator that was triggered on the Qs yesterday. That is probably the most significant development I've seen in quite a while. We already had the low volume signal trigger on S&P 500, but I like to see both QQQ and SPY confirm sell signals. So we have that, and again, you can reference that in yesterday's video. It's not a timing indicator, but it has a pretty good reliability. So that would indicate a correction anywhere from imminent to within a couple months, usually at most. And as this has been one of the most resilient trends in a while, the trend is certainly losing momentum. I'm going to talk on that, but it's still a bullish trend since it's been so resilient with so much government support, as well as the economy coming back online after being shut down last year. Where you want to give the benefit of the doubt, and you can certainly. You can do whatever you want whenever you want, but it's can't make a case to go super aggressive on the short side until at least we get the sell signals in price, and those are again those purple lines on QQQ. Roughly 380, 50, you want to call it 380, on a 380 point security, you can round that 50 cents down if you want to be safe. You can wait for a solid 60-minute candle, a daily close, it's up to you. The more evidence you wait for sell signals, the less favorable your price is. So there's always that fine line between balancing getting in early or not too late versus waiting for a preponderance of evidence to go long or short a security. So that's that. Minor level there, 441.84 in the SPY. This again 60-minute chart, just like we were looking at on QQQ a second ago. And then, two pretty decent support levels that should do the trick of taking out about 438 and then 436 down there on SPY. And again, potential targets there. Okay, so again, same story, kind of grinding higher, no sell signals, divergences build, red flags continue, or yellow flags, if you want to call them that, continue to build. But what we're going to do today is look at some sectors. Let's just dive right into those. Okay, if you recall, a few weeks back, maybe less than 2 months, about 2 months ago or so, well, let's see exactly when that was. It's been about just over 2 months. I was watching and tracking XLF, really two sectors, the industrials and the financials, but really waiting for the financials to crack to indicate, we'll likely see a correction in the market. And we got that. We had the sell signal right there, came down. We hit my first target. And then we hit it again. We had positive divergence. And so I want to just say we've come full circle. We've had a counter trend rally. And I still fully maintain T2 and T3. It's just, you sometimes, and quite often, you have a reaction, meaning a consolidation, which we had a little both, and or a bounce off the initial, in this case, subsequent tag of the first target. And all we've done is gone on to make a ever so slightly marginal new high. I mean, by a fraction of a percent or so there. So we basically have tested the that previous high, and in doing so we extended the same divergences that were in place. And again, I'm pointing out the financials because they've been a big beneficiary of the Fed's easy money policies, and certainly helped carry the markets up to where we're at. But there it is. So from a technical posture, nothing's changed. We had a breakdown. First target hit, bounce as expected, maybe a little longer than expected. But again, technically we didn't really do much because we're just back at that previous high. And now if we keep going up, it will do much. It'll take away the divergences, and it'll kind of foil that whole bearish setup there, and greatly decrease the odds that we're going to see T2 or T3 hit anytime soon. But as of now, I just wanted to update that. And XLF is the financial sector ETF. It's not the pure banking sector ETF. This is just you can look at BKX for that, and we'll go through the big banks. I just want to point that out, that the big banks, they did peak back then. JP Morgan, that was the high right there, still shy of the high. You can see right here. Bank America topped here, broke down from the uptrend line, put in divergence on the RSI, had a little counter trend rally, but we're still below there. So this is what I'm watching, and I just want to point out on that sector. If these banks can go on and take out those highs and burn through these. If Bank of America made a marginal or equal high anytime soon, it'll still be a divergent high, just like XLF just had. But I just wanted to point out where they're at. Wells Fargo was the strongest one of the lot. They're the only ones that did go on to make a new high. The big banks, and when it did, it also put in, just like XLF, additional or extended the divergence. And then last but not least, you have Citigroup. So there's Citigroup also still well off that previous high. There was your breakdown right here. Initial leg down, put a little divergent low in there, had a counter trend, what I view to be a counter trend rally. Only time will tell. Maybe this was a counter trend pullback, and there we do this. So as of now, I still favor this, and these are the other next targets on Citigroup, about 62, 57, 60. Let's just hold that one for now. We'll see what happens. We'll see where we go from here. Okay, so that's the big banks, the mega banks. And also at the same time, I had mentioned that KRE are your regional banks here, regional banks in the U.S. And you can see we broke down. We had our sell signal here, breakdown. That was a divergent high right there. And we've been moving lower and still below there. We hit this uptrend line recently. And if and when that goes, that should take us down to this next target zone, and ultimately I think at minimum coming down to this 54.32. So that's what the banking sector looks like. It's just one of several out there. There's 11 sectors in the S&P 500 and many different subsectors there within. This is not, the financials are not the highest weighting, but it is an important sector to the economy. Let's just glance at from the weekly chart. There's KRE. There's XLF, what it looks like on the weekly chart. And you can see right now we have on the weekly time frame for the first time in a while some pretty steep divergences setting up right now. You can see these indicators on XLF on the weekly time frame making much lower highs as price just made a new high. That is negative divergence by definition right there. Price making higher highs, indicators making lower highs. And there's a potential long-term trend line. And this is where I still think, and I mentioned it back here, I still think we come down to about that 31.35 level on the next, after the next correction has played out. Again, it's an initial kind of rough target right now. Probably get a reaction on the trend line. But just wanted to update that. And then you have a few others like XLY. XLY is pretty weak today. That's the consumer discretionary ETF. And you can see on this weekly time frame as well, you have this pretty clean uptrend line. We're testing it right now. We've been diverging for a while. See the negative divergence building, just like you had divergence here. There was a divergent high. That was good for a drop of about 37%. There was your previous divergent high. That was good for a drop of, oh, there it is measured out already, 22%. And based on these divergences, I'd expect nothing less than that, well into the double digits, and probably take us down, just want to give a rough target right now. Sure, something like that. And let's say a minimum target right here, 155.60. And maybe a second target if things get ugly down there about 142.30. And I also mentioned the industrials still below their breakdown point right here. Industrials, this is again a weekly chart, and looks like everything's stalling out here. It's you turn off all the lines, you see a lot of momentum, a lot of stimulus into the markets off the lows back in 2020, and pendulum overshot pretty much to the downside quite a bit. Economy came back online, but there we are. So just wanted to update those sectors. And that's what XLI looks like on the daily time frame. There was our trend line, our breakdown, and like everything, it's I know you have to be losing interest if you don't live and breathe this stuff like me. It's just been a sideways grind when you look at the bigger picture in a lot of sectors, a lot of stocks, and there's the other thing too. You look at the market leaders. You look at Apple. Let me turn off all the lines. Back here was their big. Well, here's the 4-to-1 stock split. Let's go all the way back here, and that happened back in 2020, and end of August, early September. You can turn off all the lines from that point. And here's the largest company in the index is the S&P 500, the Nasdaq 100, and they're up 9%, and that's again over well over a year and a half right there. And again, it's not going down, but a lot of these big market leaders are losing momentum. Not all of them. Some are better than others, but Amazon, same thing. Amazon peaked. Well, it peaked recently, but from where it was back the same point when Apple topped back there. Or I'm sorry, not top, but put in that major high back there after their split. Amazon's down about what Apple is up, and again, so these are your biggest companies in the world. They're incredible profit machines, and they continue to blow it away. But the market is really just not, it's saturated. These stocks are saturated. They hit a point where who doesn't own Amazon or Apple right now? What hedge fund or mutual fund out there, as long as it's in their perspective to buy these type of companies? What I'm saying is, utilities, mutual fund isn't going to buy Amazon, but growth funds will, retail funds, things like that. So that's kind of a bigger picture. Okay, so on a related note, Amazon is, well, can't say the undisputed king of retail. You still have Walmart. Walmart's may still be the world's biggest retailer. I'm not sure who takes the title right now, but let me go and look at the retail sector ETF. This is XRT, and there's others out there, but this is the Spiders S&P Retail ETF. And again, you can see when I turn the lines off, that's probably showing you best. It's not going down, but it's not going up anymore. It's flattened out here for months. In fact, I can put a line right there. I might already had that line. Yeah, that line on the top should be right about there, and that comes in with this previous high, that spike high back here. So it seemed a lot happened back then. That's about when, well, that was earlier this year. I take that back. That wasn't when Apple split. Apple split last year. But there it is, a major reaction high, and we're stalling there. So take it for what it's worth. Can't say it's bearish because you're not going down. Can't say it's bullish. It's just a stalemate. It just shows momentum is kind of waning. And when you look at it this way, this helps show you that momentum waning. It's like when you throw a rock up in the air, you're a kid, you're out at the lake or whatever, or wherever, you throw a rock up and it's going fast. And then at some point it seems to stop and just float in the air. And that's where the momentum is turning from, heading upwards, stalling out, and at one point it actually does stop, and then it starts to come down. That's what this looks like, more so than any type of high-level consolidation with a breakout to come. Anything is possible. I always have to say that because anything is possible, but you look at valuation metrics, go back historically. Where this is the market's the most overvalued it's been, I believe, since they said the dot-com bubble. So that's 20 something years ago. As far as the S&P 500, we look at sentiment extremes, everything else. And so to think that we're going to do this, well, only the way that's going to happen is if just we have even more massive stimulus come from the Federal Reserve, and I don't think that's even possible based on where they're already at with the near zero rate interest policy. So. Okay, so where am I going? I'm going with trade ideas. Let's dive into those. XRT is one, certainly, but you're going to have companies in there like Amazon and some online ones. Last few months I've shared one of my favorites is more of a trend or position trade. It is not an exact timing like get in, get out. It's not a typical swing trade, and that is EMTY. EMTY is the Pro Shares Decline of the Retail Store ETF. So what they're doing is they're betting a short. It's an inverse or short ETF that is betting against a basket of stocks that have retail stores. And here, let me show you the description here. We have, this is it. Talk about it right here, and it is short exposure. It's non-leveraged, so one-time inverse to the slow active Pro Shares brick and mortar retail store index. So that's what they're doing is brick and mortar stores. They talk about it right here to be included in there. The retailer must be characterized as receiving at least 50% of its revenue from retail operations, 75% or more of its retail revenues from in-store sales, and be a U.S. company. And of course, the market cap must be at least 500 million, blah blah blah. And they want volume in those. And here's the holdings, and that's what we're going to go through. I'm not going to go through each and every one of them. I'll go down to, let's say, target right here, and that covers, the biggest holdings in there. And there's 43 holdings, so you are diversified. P ratio on those stocks collectively is about 17, so they're running pretty rich right now, obviously. And if you couldn't see those here, I'll zoom in. I realize I forgot on the video, you can't see what I can see. There's your holdings. So again, we'll go over these, and I'm doing this for two reasons. Number one, if you want to keep it simple, as always, an ETF is like a mutual fund. It's diversified. You buy one security. Your commission is either zero or very close to that at most brokers nowadays, and so it's easy in, easy out. Again, I don't have a hard buy signal on this one at the time, so it's just something I'm throwing out there. Now, what I will be doing in this, the other takeaway from this, is some of these, all of these actually, are potential trade ideas, all on the short side. I'm going to go over the charts. Some I like better than others, and that's what I usually do in these videos. I'll tell you when I share a trade idea, what my convictions are, how strong or not strong they are. I also talk a little bit about the timing. I'm very clear. When I was looking at these, a lot of these companies in this ETF, a lot of the holdings were also in the some short trades I rolled out a few months back. For example, WGO was in one of those short trades. Not saying it's in this ETF, but it was with a cluster of those other and retail stocks that I shared. And that one at the time, one of the last updates was right here. Let me go back to this. On May 17th. In this video here, I was covering Winnebago, told you it just broke down, triggered this red candle, triggered a sell signal. I give you a measured target. I said there'd be a stop along the way here. I had a line here, it's at 66.58, and then favor to move down to this target. There was a target range. This was your measured target right here. And the measured target is simply the distance from the head down to the neckline on a head and shoulders pattern. So that's what this was. You had a left shoulder, right shoulder one here. Why don't we get to the chart? Anyway, so I was calling for, I think it was about a 19% drop down to that target. And again, what made me bring it up is when I was looking at the watch list that I had with those stocks in there, many of these that I'm about to cover right now in this empty ETF were also in there. So there it was. There was the that was the May 17th video, was right here. We had that sell signal. Went on from there to make almost a perfect tag of my preferred target, that's 60.88. And I said there'd be a stop along the way here around that support level, and there was. That's your stop, meaning a reaction. I said it was a support level. We bounced, and the drop from the breakdown was roughly, 18%. Now, I'm also covering this for two reasons. Number one, because the trade came full circle. That is a textbook head and shoulders pattern, complex head and shoulders. Sometimes you have just one shoulder on each side. Sometimes you have two shoulders on one or both sides. But there's your pattern: left shoulder head, right shoulder one, right shoulder two, neckline, breakdown, target hit. That's when you'd want to cover because your measured target was hit, which also came in with the support level right there. And we've come full circle. We bounce back to this. This was support right here back then, 73.60, and we failed. So I believe there'll be another leg down. PPO's turning down back to that 60.88 target again, and quite likely the one below there. So that is a potential trade. But now let's get back on point, and that would be covering the holdings of empty. So I'm going to go through in order the largest weighting, starting there. And this was covered at the same time Winnebago was. Signet Jewelers, the chart on that one had this primary uptrend line right there. There was our breakdown, sell signal. These were all potential targets listed, and I maintain all of these targets. This would, if my final target is hit, that's going to cut the stock in half from where it's at. The stock's trading at 66.05 right now. My final target's about 32.04, so just over the $32 level. And so far, so good. You can see how it's again, these lines I haven't modified this chart in a while. Hit that first target, hit it again, bounce back to the well, that was the first support level. Bounce back, support once broken becomes resistance, and we're in that range. So you can short it here up around that 68.39 resistance for a swing down. We've already tapped the bottom of that first channel or first target for support a couple times, 61.24. So I'd expect it to break the next time around or soon thereafter. take us down to 56 would be your next target. 51.20, 46.89, 41.12, and then ultimately, if things get ugly, $32. And again, this and all the ones I'm about to cover are holdings of that EMTY. So if you want to keep it simple and not have to worry about navigating earnings and other things like that, you can just go with an ETF. Bed Bath & Beyond. Yeah, this one, the chart's a little bit different. The levels aren't as clear. We did have some extreme overbought readings down on the RSI. You can see below. Again, wonky looking chart. Not one of my favorites, but if you are interested in it, there's an uptrend line, which we're just starting to crack. You probably can't make it out in the video, but just below the current price levels, I have both the 200-day simple and exponential moving averages. They've come in as support right here once they were recovered. And so when they go, let me give you, there's a line that should be turned on here. A level that is 2285. That would be your first target. Second target 1787, and let's just leave it at that for now. And again, so it's cracking the trend line. You could actually take a short here, and all the better if and when those 200 days get taken out. So that's the second largest holding in EMTY, and then you have Buckle, BUCKLE. I'm not even sure what they are. Apparel store, I guess. There's an uptrend line right there. Once that's taken out, that should take us down to 33.77. Again, keep in mind these are actual support levels, what I call unadjusted price targets. You want to cover a little bit above, maybe on that one, for example, 33.77. I might cover at 33.82, 33.85, somewhere in there. Next target 30.83, and then 28.71. Again, sell signal to come on a break of this trend line. This was a divergent high right here. Like a lot of these stocks, been building divergence for a while, and just like Winnebago, I haven't lost faith in the charts. There haven't been many short trades that have played out, and that's just because the market, the primary trend, has been bullish for a while. But those that have, clearly bullish or bearish charts, those technicals will usually play out despite the overall trend. In this case, this is a clearly bearish chart, but just needing a sell signal. So this is a trade setup, unlike the previous one, which was an actionable trade because it just broke down. Dick's Sporting Goods, DKS. There's your uptrend line. Divergent high right there. First target 90. Some of these charts I need to do a little more studying on, and I would definitely give you a second target there, about 71.90. So let's just talk about those two. I mean, heck, if that's hit, from where we're at right now, the $90 first target, that's a drop of about 17%, and that second target I gave you is about a 33% drop. So those are aggressive enough. I'm going to turn this one down for now and just say those are the two targets for Dick's. And again, Dick's is a setup because you need to take out the trend line. Next up, ODP. ODP Corp has about a 2.58% weighting in EMTY ETF, and same story. A lot of these are very similar charts. This high was a divergent high, meaning negative divergence. There's your uptrend line right there. So this one is pending a break of the trend line for a sell signal or a short entry. First target 37.54. Second target is $30 horizontal price support and or this uptrend line, both which would probably come in around the same time right now. So that, again, a lot of meat on the bone for these guys, and they've like I said, that rock has been thrown up very high. I think gravity will kick in here soon as they're peaking out, and I think once you start to get some downside momentum based on everything I'm seeing, the excesses in the market, valuations, excessive bullish sentiment, things like that, low short interest. Once the dam finally breaks, it might not be. So far, it's been a slow roll. I thought we'd have more of a sell-off. Now we don't have like sell signals on the majority of ETFs and sectors that I'm following, but when we get those, that's when I think there'll be a pretty quick rush for the exits. It's going to be a crowded rush for the exits. That's what happens in the stock market or any individual stock when everything's lopsided. You have too many longs, on one side of the boat, not enough shorts and bears on the other, and then you get everybody selling at once, and that's what causes those quick moves down that you sometimes, you get them in the market in recent history, every couple times a year at least, and we haven't had one in a while. So there it is, a lot of potential. Again, down to that target would be about 33%. Let's move on. There's only a few more, and we'll wrap this up. Next one up is ZUMZ, and that one, same story. Again, sound like a broken record here. Divergent high right there, nice one. This has a nice support shelf there, about 39.42. You had a major reaction high there. Once we broke it, it was a clean breakout candle. See that big green candle breakout? We back tested it, back tested, back tested, back tested, boom. So if we can break 32.49, one of my favorite shorts, I'd put up very good odds that we'd come down, hit these two targets, minimum target first and minimum target 35.42, and then 35.31. I'm sorry, 31.35. AEO is next. That's American Eagle Outfitters. Again, nice, clean, negative divergence at the high. Beautiful trend line. Look at that trend line. You had divergent, positive, bullish divergence at the lows. And we've come full circle. That was a catalyst for this uptrend. And again, on these retailers too, keep in mind, guys, tons and tons of government stimulus directly, not just into the economy, but to them. Payroll protection program and other government monies that kept a lot of these retailers afloat. Everything I've talked about, I would suspect a good percentage of these stocks, or a fair percentage at least, are junk bond. They're being financed by junk bonds, low quality bonds that they've issued to continue their cash flow and their operations, and I've already talked on that, what's going on in that market. This one, had I pointed out to you yesterday, I would have said it was an objective short entry on a break of 32.28. That happened yesterday. We closed below it. We've almost hit the first target. I still think we will. 30.40 would be the first target. And at this point, well, your objective short entries would be a bounce back to 32.28, give or take, and or a break of 30.40. We're kind of in no man's land. We're halfway between the that support level that just gave way and that next target or support right there at 30.40. So, not the most optimal entry, but I do think it'll continue on down here, probably that next target ultimately of $24. You can see there's your divergence lines. Here's the indicators crossing down. A lot of these indicators, PPO is crossed below the zero line. It did so right here, putting the trend as bearish. Again, that's delineates bullish trends. When this signal line, the white line, is above it, the trend is bullish, and when you cross below, the trend is bearish. It works well for a lot of stocks and a lot of indexes, and it's also support or resistance. When you're above it, it was support right here. We hit it, we bounced, but then we have crossed, and we are clearly below that level now. So that's why I see more downside in AEO. Dollar General, DG, nice setup here, clean uptrend line right there. There's your divergence line, forms a bearish rising wedge pattern. We had a divergent high right here at this point, a small one, right there. There was your divergence, and that led to that correction. And now we have an even bigger pattern. We have sometimes on this one you get the divergence on the RSI like you had here. You had it right there. That was a divergent high before that big drop. Right here you had PPO divergence, but only an overbought condition on the RSI, PPO or RSI and PPO divergence. But here you have an extreme overbought reading on the RSI, which we're just coming off of right now. So at bare minimum, and I put very good odds, this one's going to hit that target. That's 222. I need to give you some additional targets because these are some of these charts I haven't updated all the levels. So I'm going to delete that line now. And let me just say at this point in time, T2 would be right here. It's about 207.50, a little north of that. So that would give you, this one has potential for at least that 10% drop. I'm going to give you a third target too because I like this one right there. Third target and final target for now, 193.20. And so that one, I'm calling for at least about 16% downside here, DG. Let's see, a couple more to go. Ulta, there's your trend line, no sell signal yet. Targets down here, let's say 287 first target. Not one of my favorite, but I do think it's going down, so certainly a shortable stock. BJS, BJ's, I'm sorry, that's BJ's Wholesale. There it is, right there, BJ. There's your uptrend line. You need to break that to get a sell signal, and if so, there's going to be a little bit of minor support right here, but I favor a move down at about 43 would be the first target, and then 37.50 for a second, and current final target for now. If things get ugly, I may add additional targets to these guys. And last but not least, I'm not going to go through them all. I told you there's too many. 43 holdings, that would take forever. That's not it. I wanted to go to Target, TGT. Okay, Target. Beautiful chart. Look at this. Nice, clean, well-defined uptrend line. Divergence has been building for a long time now on this one. So big divergence right here. There's your divergence line. And again, we had divergence at this point. We had it at this point, and so it's not as if these divergences didn't play out. They played out for corrections. Bigger the divergence, the bigger the correction, and now we have much larger divergence, and this one's actionable. There's your breakdown candle right there today. Yesterday we broke intra-period, but look at that. We whipped back, had a stick save, closed right back above the uptrend line, and today we have a solid red candle, and that is a sell signal all day long. Targets, I need to give you some additional targets. Those are lines I've had on the chart. Let's just say right here, first target 237.50. Probably something in here, a little reaction possibly around here, but this is my preferred target right here, 199.70 at this point in time. And so that gives you, if you don't want to try to, navigate the minor squiggles or try to, play the counter trend bounces on the way down, you're looking at about a 21.5% drop on target from where we're at right now. Call it 21%. All right, and I will wrap it up there. And again, EMTY, when I look at this chart, it's not a screaming buy because I don't have a well-defined trend line. Remember, it's a compilation of 43 different companies, and I just went over the top 10 or so and showed you which ones I like the best. So you can either go with the individual stocks, go with this, or if you think this market has a lot more juice and this Delta variant's not going to put the brakes on the economy, or just natural forces. Even if Delta variant vanished tomorrow, we still have a Fed that is already, pretty much being forced in a position to start unwinding their easy money stance. Inflation has, it's crazy. The last CPI number that came out a week or two ago, the numbers were still hot. It was just lower than the previous month, but it was still a gain of inflation. I forget exactly what it was. I think previous month it was like 0.4%, or whatever it was, month over month. And we still had, positive, a strong increase in inflation. I mean, I don't have to tell you this by now, unless you've been living in a cave somewhere for the last year or two. Inflation is rampant throughout this economy, not just food, but used cars for the first time in history, I think, have become an appreciating asset. When's that? When have we ever bought a car? Man, I just traded one into CarMax yesterday. Sold a car I bought for my son 2 years ago. And I think, what did we make? I sold the car for several thousand more than I paid for it. It was hard not to take the money. You can go online, plug in your VIN number, and they'll give you a quote good for a week. So just FYI, if you've got a used car you've been thinking about selling, now would probably not be a bad time. Of course, you have to roll into something new. That's the flip side. Okay, I digress. Let me wrap it up here. Plenty of trade ideas here, and I will continue to update the commodities and gold and everything else I've been looking at recently. I'll do that in a separate follow-up. This has been Randy Finney with Right Side of the Chart. Have a great day.